Hey y'all, it's Monica Perez, that is, and I am here with a returning guest, Jason Purcell. We have had a series of conversations about de-dollarization and dollarization, and I was shocked to realize this thing went from one show to a series and that it was actually amazingly popular. I thought I was just indulging my own quirky nerdiness, but apparently it's a fan favorite. So thanks for coming back, Jason.
Yeah, thanks for having me. This is awesome.
And because of that, I thought it would be nice to give people an opportunity to ask you questions. So probably won't get going for a little bit, but let's start. Let's try to hit the current stuff. I know we have to catch up on a little bit of the Bretton Woods era, which was an important era, but I feel like since there's just been a lot of economic news lately, and I think people really care about the interest rates because of what that means for them personally and also for the election and stuff. So let's just
Yeah,
get into that. If people have questions, they can ask. If you're going to ask a question, put a little asterisk at the beginning so that I know that you're not just chatting. People chat in the comment section, which is super fun, and I don't want to interfere with that. So,
for
okay.
sure.
Um,
Sounds great.
Thank you. All right. So you sent me a paper that you wrote, which I love because it's funny. And I just love that. Like when people write stuff that's totally mathy, but also makes me laugh. I mean, anyone else listening and reading that will not think it is, quote, funny, but it's just, I like the lighthearted way it's written. Is
Somebody
that
else I
something?
sent it to said they couldn't get through it without falling asleep, so I'm glad you enjoyed it.
Oh gosh. Yeah. Well, I am a little nerdy like that, but it's just funny. There was when I just read something. Um, Yeah, it's just very funny. I never heard of where's my favorite thing? It says, okay. It says the main price index that the news cycle and Wall Street pay attention to is the consumer price index, but we're looking at core PCE because that's the one the Fed cares about. Most people will look at the PCE figures and think inflation is way higher than that. They would be correct. Most people's grocery bills have doubled in the last 3 years. PCE doesn't represent the lived experience of any human being on earth. We're only looking at it because it's the index the Fed likes. That is just true. And it's kind of
Yeah,
funny. But
I
it's
agree.
really at the heart of what's going on right now because I personally I feel like the prices that I'm paying are twice as much, the grocery store, everything. I'm still recovering from being the youngest of 9. Like the fact that we're not living hand to mouth, I just never care about grocery bills. I'm just in this permanent state of just like I'm not worrying about how long my shower is, not
Right.
worrying about my grocery bills. And now I find myself being like, are long showers super expensive? Like, do I need to start worrying about this stuff now? Because we're definitely feeling the pinch. So tell me, you know, what you've been working on with respect to interest rates, and tell me why it matters.
Yeah, so if you go back into, I would say 200 years of financial business cycles, or economic business cycles would maybe be a better way to say that. The first canary in the coal mine, as far as is there trouble ahead, is the rate of interest. So the Panic of 1907 is a specific episode that I looked at recently because it, in a couple of ways, mirrors what's happening in China right now. But I only bring that up because one of the big indicators in the Panic of 1907 was the interest rate that banks would have to pay and brokerage firms and all these financial companies would have to pay for money on the street in order to take that money and invest in securities. Well, it went from about 5% one day to about 10% the next day, and then 15% the next day, and then 20% the next day. You always see big financial problems in interest rates. That's, like I said, it's a canary in the coal mine. When the great financial crisis happened in 2007, people call it the GFC of 2008, right? Or the global financial crisis, however you want to say it. So it began in 2007, specifically in August. Well, one of the first indicators of that was you started to see the London interbank offered rate. So that's the interest rate that international Eurodollar banks, we talked about the Eurodollar system. So that's the rate that they pay to borrow money and the rate that the ones that are lending to those banks receive to borrow money. Well, you started to see a huge blowout in what's called the spread. It used to be called the TED spread. But the most common LIBOR rate, London Interbank Offered Rate, the most common LIBOR was 3 months. That's, going back into antiquity. That's a really, really common interval to borrow money at. And it's because of certain travel times between the major financial centers in medieval Europe. But anyway, we talked about that actually
So
a couple episodes ago.
these are so there's demand deposits and then there's what, time deposit? What is the other thing called?
Yeah, so the Eurodollars are time deposits. Yeah, so it's I'm a banker to a Gulf state oil firm, right? Maybe based in the UAE, and that customer puts $1 million in my bank. Okay, well, I'm a bank, and let's say I just want to put that deposit to work I have to pay interest to that UAE, that Emirati oil baron, right? So the most easy way that I can put that deposit to work to get interest on it, so I can pay interest to my customer, is just to forward it to another bank. And then that bank is going to take it and maybe they turn it into a consortium loan and they lend it to, the Argentinian government or the Mexican government or whatever. This all
Okay,
kinds of stuff.
so I actually think this is important because you're doing, I think we might have touched on this before. When you put money in the bank and you expect to get it back at any time, that's a demand deposit. And you
Right.
should not get any interest on that at all. They should have it right there ready for you. They should not be able to make money on it. But they do
So you,
because yeah, they
so you,
are they're
yeah.
multiplying it by 10 times and they're lending it out and they don't care. And if the bank does collapse because everybody comes to get it at once and they've lent it out, we have federal deposit insurance, so it's the whole entire government would bail it out, which we've seen happen basically.
Yeah, and you bring that up, and I totally agree. You know that my poster child, my mascot, if you will, for responsible banking is the Bank of Amsterdam, at least from 1609 to 1780, before they screwed it up.
Okay, Jason, that's
Um,
incredibly nerdy.
well, yeah,
My
but they did
favorite
it.
bank is the Bank of Amsterdam
Well, yeah,
from the early
only
80s.
for those years though. After 1780, it all went to shit, right? Because
Who can you talk to about this?
you.
Thank you very much. That's very sweet. I can't like give you a sparkling retort about, oh, but you're forgetting blah blah blah. But anyway, I appreciate that you're sharing it with me, but I feel like, it's wasted because it's so fun. Like you have such a grasp of the subject that it would be super fun for you probably to interact with people. But I'm glad that you're putting it down on paper, writing a book. Maybe it'll stimulate some of that back and forth.
Well, honestly, I mean, I think you have enough of a grasp of it as well to, ask really good questions, and then I ask you good questions. So, I mean, I was telling it another somebody else whose podcast I've been on that, I like the way that we've been able to interact. I think it goes really well in
Yeah,
general.
it's
So,
super fun. It's easy to digest the information when it's like a little when it's back and forth a little bit. So,
yeah,
okay. So we do have a question from Gentleman Skeptic for
right.
clarification.
Okay.
Would the PCE be like the shadow stat to the CPI?
Yeah, I'm glad you asked that. Good clarifier. It's actually the opposite. So the shadow stats are a formulation of the consumer price index that I don't. So forgive me, everybody in the community, but I don't put a whole lot of stock in shadow stats
Oh, really?
because during the 10 years after the great financial crisis, they were saying that inflation was like, 7% or something. And there have been a couple of attempts, papers I've read to replicate their formula, and they come up with different results. So the idea of shadow stats is a good one. It's the Bureau of Labor Statistics has changed their formulation of the CPI several times over the last couple 4 decades, really. So the biggest one that they did is the biggest component of CPI is shelter, and about 30%, or excuse me, about so that shelter is
Rent
30%.
and housing prices, both?
Rent and housing prices, yeah. So that's 30% of the index. 20% of that is owner occupied housing. So not apartments, but it's home
Okay.
ownership. In the old days, they used to measure that 20% of the index by actually taking the prices of homes, right? Which makes sense because
Mhm.
somebody who wants to own a house is going to have to pay the price of a house in order to get into one, right? In 1984, I think it was, they changed that to a stupid, ridiculous measure that's called owner's equivalent rent. And the way that they find that is they have a sample of homeowners and they go to those people and they say, if you rented your house out tomorrow, what would you get for it? And then that's how they calculate the percent change from the
I
previous month.
just
It's
I
completely
hate
ridiculous.
asking people questions. Like
Mhm.
you there is such a tremendous psychological impact. If you ask my mother how much her house is worth, oh, she'll tell you all the time, 475,
Yeah, they don't know.
475. And we're like, it's 350, mom. You're never
Much
getting
less how
475 for this house.
much less how much you could get renting it out for,
Yeah, no, it's a
who knows that?
completely it's like everything. I mean, going to the doctor, how much, they ask you how much you drink. It's like 100% of the time they have to add
Mhm.
50% to that because no one is even aware of how I hate that. It's terrible.
Exactly. I
And
always say
it's
3
such
drinks a week times 8, and you arrive somewhere close to the nearest, ballpark answer. The truth.
well, the thing about the housing though is there's a totally robust and well reported market.
Seriously, yeah.
I mean, it
There is.
completely
There's no reason
clears.
to do it
There's
this way.
Yeah, that's just really, I mean, there has to be a reason for that, which goes to like a couple of other things. When you're looking at inflation rates, when you're looking at interest rates, and you mentioned this in your paper, which by the way, can I share this paper in the
Yeah.
show notes? Okay.
Yeah, sure. Mhm.
So you mentioned in the paper that the even the interest rates themselves. So you're talking about 1907 and 2007 and today. 1907 was very, very different because it was before the Fed. And I'm sure even when the Fed
Mhm.
was first established, it wasn't like it is now, where the interest rates are basically, I would say, almost entirely artificial. I mean, they can't be entirely artificial, but they're highly influenced by these policies.
Short-term rate definitely is, yeah.
Yeah. So I think you're about to tell us why, like, there are flags, there's information in the pattern in the interest rates right now,
Oh,
but
yeah,
please
yeah, yeah, yeah.
include
Mhm.
how that squares with the fact that these are really artificial numbers.
Yeah. So I want to get to the exact answer for Gentleman Skeptic's question. So PCE, the reason I say it's the opposite of a shadow stat is because it tends to come in lower than CPI. Right. So the idea of shadow stat is we measure CPI the way that it used to be measured. And so it tends to come in higher because all of the changes, big coincidence, right? All the changes that BLS has made to how they formulate the CPI have tended to make it lower, right? Interesting. Um, so anyway, the idea of shadow stat is, like I said, is to measure it the way it was done 4 years ago. Well, PCE is done a little bit differently, and it tends to come in lower, right? So, and because Monica's going to share it, so if you do take a look at the white paper or whatever, you'll find that that's explained. Like I said, the only reason we're even looking at it is because that's what the Fed does. So interest rates, the deal with what's going on there is the key indicators. So we talked about 2007. So there was 100 years ago, and then there was there was 100 years ago, there was 1907, and then 2007 there was a big blowout in interest rates again. So the other thing that happens is the interest rate on the quote unquote risk-free securities tends to go way, way, way down. So whenever the yield on a bond, whenever the interest rate on a bond goes down, that's indicative of a lot of people piling in to buy that type of bond. And so the other thing that we saw during the great financial crisis in 2007 is before the Fed. So what does the Fed do? They control the overnight rate, right? They're in charge of Fed funds. Fed funds is the rate at which one bank will lend bank reserves to another one. So it's basically they're taking money out of their account at the Fed and they're lending it to the other bank into their account at the Fed for an overnight. Sometimes it's term, sometimes it's, a week, maybe a couple weeks. But we call that Fed funds rate. That's the rate that they control. And the Fed controls a few other rates too, not just that one. The Fed also controls what rate they're going to lend at, which is called their discount rate. So that's when a bank is in trouble and they need that lender of last resort money. They need to go to the pile of gold at the end of the rainbow and say, please save me, Fed. So they control that one. And then now they control this Repo is a little bit more complicated, which we'll talk a little bit about because it's kind of central to our story right now. So they control the short run rates, right? So 2007, you see the 2-year bond yield. So the interest rate for bonds of 2 years to maturity, United States, tank, and that
So
happens
that's a
without the Fed.
flight to quality, right?
That's a flight to quality. Yes, exactly. Yep, flight to safety trade. Uh-huh. And then you see the same thing with the 10-year, right? The 10-year bonds, the 1-year bonds. When you see or when you know that whatever's about to happen is really close by is when you see it in the T-bills. And by that I mean you've got your 3 months, you've got your 4-week, you've
Mhm.
got your 6 months, those kind of things. So then when you start to see the yields on those, the interest rates on those plunge, that's when whatever's about to happen is about to happen.
So is that a steepening of the yield curve usually? Like, so the longer term interest rates, do you look at the difference between the short term interest rate changes and the long term interest rate changes?
Right now, what I'm talking about is just the level of
Right.
any one of those
Got
rates
it. Okay.
tanking. As far as the shape of the yield curve during those times, it's the long rate is going to tend to move less than the short rates do, and so all else being equal, that's going to let's see. The yield curve would probably get a little bit steeper. And ultimately, if you look back through history, when you go into a recession, you have an inverted yield curve, which means that the long-term securities are paying, the 10-year is paying a lower interest rate than the 2-year. So you're going into it, and that's your situation. If you go
That's
back through history,
impossible to understand. It's like as if they expect a lot of illiquidity, but not insolvency, maybe?
yeah, well,
So cash problems in the short term, but they don't actually think, right? Because I guess interest rates are a measure of like risk and time.
mhm,
So you have to pay more to borrow something for longer.
yeah.
But if it's riskier, which a lot of times it is riskier if it's longer, that makes it go up. But if you're having an inverted yield curve, it seems to me like the risk in the short term is outweighing even the impact of giving your money away for a long time. Like the chances are you might not get it back in 3 months, but if you gave the guy 10 years, you probably would get it back.
Yeah, and I think the whole problem with that discussion is that, and this is why economics is not like I hesitate to even call it a science
Yeah.
because
A social science thing. Yeah. Stupid. Yeah.
nobody agrees on where interest rates even come from, right?
And you know what? Even when they're proven wrong, like I remember saying this
They
about
just stick with it.
Bernanke. It's like
Hmm.
he's doing the wrong thing and it's going to be a disaster. And I mean, yes, they didn't allow things to collapse, but we are now paying for his mistakes from 20 years ago. It's like, you know
Yeah,
what? He'll always
agreed.
be considered a hero because he followed the paradigm that they wanted him to follow. And that's what you get. And even if it's that virtue signaling thing, even if I feel like that for the vax probably, like even if you're proven right about, say, it's dangerous and I didn't take it and see, I'm right. You're still wrong because the right thing to do would have been to follow the existing paradigm, as a solid citizen or whatever. And that I think is very strong in academia. And I would
Hmm.
consider this academia. But yeah, so it can't possibly be a
Absolutely.
science because it doesn't, even if your experiment doesn't work out, they don't change it.
No, no, no. I mean, the biggest example is the Phillips curve, completely disproven in the 1970s, right? And they just still no. There's a Phillips curve. There's a trade off between unemployment and inflation. You know, Phillips curve is the idea that you can add inflation to the system in order to decrease unemployment, and then vice versa. So if you tighten monetary policy, unemployment goes up. If you loosen monetary policy, then unemployment goes down.
Right.
But
And that
the
is absolutely
consequence is
not true.
inflation. Well, yeah. So the Phillips curve predicted that in the 1970s, if it held true, there really shouldn't have been an inflation problem, right? Well, guess what? There was. You had high unemployment and high inflation at the same time.
Oh,
So
yes,
that's Phillips
stagflation.
curve.
I remember
Goodbye.
that. Yeah.
You know,
Okay, good.
but
Yes.
they still,
Yeah, they still act like that's true. Okay, go ahead.
yeah. Okay, let's see. Where were we at? Oh yeah. So I think a lot of what's going on right now has to do is global in nature, and it has to do with China. I don't know how bad this is going to turn out to be in the United States, because the United States debt burden is, we think it's really, really big because what we hear about is government debt. But when it comes to a big financial bust, the type of debt that we're really concerned with is actually private debt. So China right now has a private debt load, and it's really hard to measure for them because they also have these state-owned banks that are intermingled, and it's kind of hard to tease out what's really public debt and what's private. But their private debt load, as well as it can be measured, is 225% of GDP. GDP being the currency
Wow.
amount of everything that the economy produces over the course of a year. Yeah, so that's
I don't like that ours is
225%.
over 100% and theirs is over
Yeah,
200%. Wow.
yeah, and ours is over one. So the U.S. is about 146, which is high, but it's not nearly as bad as China. Korea is I think Korea is also in the 220s. So I wrote an article several months ago about Korea might also being on the verge to a crisis as well.
South Korea.
But, yeah, yeah,
South Korea. So
the Republic of.
Russia, last I looked, which was a very long time ago, had a rather low debt to GDP. Probably, I mean, I thought at the time, it was that long ago, that it was because they went bankrupt in the 90s. Like they literally just like walked away, if I recall
Mhm.
correctly. It's that book, like The Smartest Guys in the Room or something. There was like, um, but I remember thinking since then, like not being able to borrow as a country,
Is
it
the
really
best thing.
imposes a discipline. Yes, that's wonderful. It would be really wonderful. And in my opinion, they have no right to borrow it. Like what Iceland did, I'm someone who pays her debts, and I think
Mhm.
I take no quarter at all in that. But to the extent that you can control, I begin to think you can't even control your politicians. So what Iceland said to the world, if you lend our politicians money, you're lending them money because we are not supporting this. We would not have consented to it. It was wrong. I think Ireland should have done the same thing. I don't think they did. But
Agreed.
during
Yeah.
that debt crisis, Iceland just walked away from their debt. And if nobody ever lent them any money again, good. Because what's the point? I always think of that as national debt is, first of all, it's taxation without representation because you are taxing future generations. It's absolutely outrageous.
Mhm.
And why does the richest society that ever existed on earth, why can't they pay their bills? And of
Mhm.
course, that's not the real answer. The real answer is they literally overspend on purpose just to rack up debt, is what I have finally concluded. And,
Yep.
my cynicism.
Well, and it's not really even a cynical take, because Alexander Hamilton himself, who I would call the founder of the United States national debt, he wanted to assume all of the states' debt because it would be a unifying force to keep the union together. It's not Virginia's credit score, North Carolina's credit score, and Georgia's credit score, and New York's credit score anymore, which, by the way, was the first stumbling block in the contention between North and South, because, well, guess what? The northern states had borrowed. Which ones had borrowed more? I think it was one side
Boy, it would
had
have to be the
borrowed
North
more.
because
Yeah,
the North would have
I'm
cared
pretty
more
sure.
about pulling away.
Yeah,
Um,
I
but
think
you
that's right.
the but if he had done that, it might have saved the Articles of Confederation
Oh
because
yeah, because they would all be responsible for
that was
paying their
the
own bonds.
that was the
Mhm.
argument they used to usher in the Constitution. Did he do it?
Oh, assume the national debt?
Yeah, did the
Yeah,
so
it was part of the grand bargain, and it was
okay,
part of
so
how
that was
they
the
got
beginning of the
the.
end
Yeah, yeah, it
for the
was. It
Articles
was
of
it was
Confederation.
it was part of the I believe it was part of the negotiations that solidified the Constitution. I mean,
Yeah.
that
Boo.
national debt assumption, and at the same time, I think that was also the capital base for the first Bank of the United States. I'd have to double check that one, but those bonds that were created when all of the national debt, all of the states' debts were assumed, that became the
Oh,
buy-in for the first Bank of the U.S.
that's so interesting because now it's all clicking into place. I didn't even think of this, but if the states rightly were responsible for their own debts, then whoever they or whomever they owed it to would have had to deal with that.
Yeah.
And then they themselves, or if they can't ever borrow again, fine. That was their silver bullet. Fine. You'd be
Yep.
better off. But it's because they upsourced it, and I think it says in that Creature from Jekyll Island about how that happens in Latin America all the time. Like they'll just restructure their debt. It's like, you know what?
Hmm.
Just walk away. Then you're just in this perpetual state of debt that you can never pay back. And that's why I don't like the microfinance and like the unbanked. There's this movement that is completely open about getting the poor in debt.
Hmm.
I'm like, give them money if you want to give them money. Don't give them my money, but give them money if you want to give them money, but don't give them
Hmm.
debt. I mean, it's just,
Yeah.
it really makes you wonder or makes you think that the Bible, it isn't usury against the Bible or whatever, that they has some serious wisdom there. Okay, we have another question.
Years of Jubilee are not a terrible idea. Yeah, I don't know the answer to that question at all. Not even
Did
a little
Iceland
bit.
pay back their debts at 1-to-1 with the GBP? What's the GBP? Even though they're
British pound sterling.
yeah, I thought so. Um, Even though their currency was valued at a fraction of the pound and oh well, okay, yeah. That may be, I'll look at it, but yes, I'm sure that would be like paying with monopoly money. So,
Sounds about
okay,
right.
great. All right, keep going. I'm sorry.
Yeah. So what is going on in China? So, or just to backtrack on what's happening in the U.S. So it's just as far as like general economic narratives are concerned. Okay. So back in early 2022, and I was really, really, really early to this table. So when I started making video, which is not necessarily a good thing, when I started making videos about money and economics and all that stuff, it was summer 2021, I want to say, and I was calling for a recession by like the end of the year. I bet my director at work that by the end of I want to say by the end of 2022 that the Fed would have already reversed course from rate hikes to rate cuts, like before the rate hikes had even started. Right. So we're nearing the end of 2023. The rate cuts have not begun. I was very, very, very wrong. All right. So, but the thing, I'm just being honest.
Yeah, right.
I have no
That's
crystal
what I
ball.
like about you. I don't care if you're right. You're actually just telling us what you really think, where you
Yeah.
put your money, which I like.
Yep. Yeah. Exactly. Um, so I did take the bond trade. We talk about the flight to quality. I took that early and had to get out because I
Oh
lost.
yeah,
Right.
yeah,
So
yeah.
I got in, I lost a little bit, and I'm back in that trade now. And it certainly could move against me, but I did take that trade about a year and a half early. And
So you're saying you think interest rates are going to reverse?
yeah, no, I don't. I'm not saying I think they're going to reverse. I'm saying they've already reversed.
Okay,
As
okay.
far as yeah, so as
Well,
far as market,
how is your trade doing?
decent. Yeah, yeah,
Okay,
it's going in the it's going in the right direction.
okay.
Yeah, because what that essentially means is that your investment funds, your ETFs that are essentially big portfolios of bonds, those are going to go up in value. Right. So interest
Right.
rate cuts mean you buy a fund of bonds, they're going to go up. If you're
They
interested
go
in,
up because they're paying an interest rate you can no longer get. So the price
yeah, yeah, yeah,
adjusts so that what you put into it is going to yield the interest rate that is current in the market. And that means
exactly.
that the price has to change.
Yeah, exactly. Exactly. That's a really, really good explanation.
Yeah,
Yep.
thank you.
It's like you were an investment banker or something.
A little bit, but
Um,
you don't know how long ago that was. Like I could have, I've forgotten things I've learned since then. So I can't remember how to be a mom. And that was my intervening period.
that's funny.
Okay. So,
Um, Yeah, let's see. Yeah, and the flight to safety trade used to be the premium on gold, like the premium of gold over dollar deposits and sterling deposits used to go up. That used to be the flight to safety trade and
mm,
bonds, but
hmm
but that gold premium used to be an indicator,
hmm
and so that real money would be dearer, because and it was really straightforward back then because what did bad financial times mean? It meant you were going to have a lot of depositors lining up to, get greenbacks and gold. By the way, greenbacks were part of the base money back even before the Fed. They were part of the base money back in 1907. So a bank could pay out greenbacks and they were still, fulfilling their contracts. That was a thing. Um,
Really?
yeah,
The
yeah, yeah.
ones from the
Green,
war?
from the war, from the Civil War. Yep, 1963 to 19
1 to
or
1?
1863 to 1865.
1 to 1, it was money, good.
Yep,
Interesting.
greenbacks were money good, and
But
people took
not
it.
but not the Confederate stuff.
Not the Confederate stuff. No, no, that was
I remember.
papel de toilette.
Yes, exactly,
Yeah,
they would use it for kindling, yeah.
yeah,
Okay,
exactly.
interesting, interesting.
Yep.
So wait, can I just quickly ask in your knowledge or impression, if that's the case, then I would think that you would import not s your import you wouldn't import that much. You would like, it would mess up your or it would in your balance of trade balance, whatever, would be you would export more stuff. If you had funny money like that, it would just be too expensive to pay. People would not even take it.
Yeah, 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 yeah. So it
Okay.
became in the South, it became very difficult to buy anything. I mean, if you were, that's why anybody who's descended from an old Southern family that was around at that time is probably has some pretty tough genes because those were some hard years.
Oh, yeah.
I mean, you're
Yeah, that's
talking
a good
about
point.
using tree bark instead of coffee,
Yeah,
like
wow. What about
that's what people did.
but even the greenbacks in the North like to
Hmm.
try to buy British textiles, but of course the North would be happy with that
They would
because
become
yeah, that's
because
I
of the
think that's what the war
manufacturing
was
base.
about.
Because the manufacturing base in the north didn't have
Right.
any competition. Yeah, it was. Yeah, it would be beneficial to them.
Assholes.
Yeah.
So see,
Mm.
that's why, and this is really important because it's so hard to intuit why the electoral college is so important, why you can't have one vote, one person,
Mhm.
because these regions that have are sparsely populated, like farm regions or, whatever, ranches and stuff like that, they're important. They have their own interests. They have massive quantities of land. They are a big part of this country. But factory and city density can absolutely overwhelm if it's 1 to 1 vote, overwhelm their vote every single time. And you are baking a civil war into your future if you
Mhm.
get rid of the electoral college. And that's exactly, it didn't save them, but that's why it's there. And it's totally valid in a huge country like this, which it probably even shouldn't even be this huge, but
For sure. No.
it's a topic for another time. Okay, keep going.
Definitely. Yeah. Um, so
So
what
okay,
happens
so
is
so interest rates are already you can keep with what happens, but I feel like right now where we're at is interest rates you think are already backing off, and I definitely want to slide into the real like the actual interest rate movement and the policies. So
yeah.
say
Yeah,
whatever you got
okay.
to say, and let's
So
make sure to slide into that.
yeah. So back when in 2022, right? Basically everybody agreed, maybe a year or so ago, everybody agreed in the economics and the financial commentating and all that stuff. Everybody agreed that there was going to be a recession. Like there were almost jokes of headlines saying the most predicted recession in the history of the world is still not here, that kind
I
of stuff,
guess
right?
predicting like 10 out of the last 5 recessions kind of thing.
Yeah,
Dot to
yeah,
doom people.
but even the mainstream was talking about it. Like if you turn on
Right.
Bloomberg, it would be like, the markets are pricing in a recession. And part of that was because, the S&P 500 and the Nasdaq both peaked at the very end slash January 2nd, 2022. And so everybody was in that mood. They were in that sour mood of like, stocks are down and, it feels like there's going to be a recession. Okay, well, in the last 6 months, probably everybody just threw that shit out the window, right? They just everybody's especially in the mainstream, the Wall Street Journal, and of course the politically minded will never admit to the fact that there's a recession coming around the corner unless they're the party out of power because they want that to be true. But the sentiment, I'll just say, because you read the Wall Street Journal, I read the Wall Street Journal. It's not the Bible. That's not like where we base our opinion about what's going on actually in the world, but we use it to figure out what everybody else thinks is going on, kind of thing. The sentiment was very, very obvious. In 2022, it was holy crap, recession around the corner. Well, 2023, maybe midway through, nah, there ain't gonna be a recession. Soft landing. It's all about the soft landing. Soft landing this, soft landing that. The labor market is still strong. the Fed can't kill this economy, blah, 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 blah. I mean, I've screenshot so many headlines in the last few months about how it's just, the Fed has engineered the perfect soft landing. They've raised interest rates from 0 to 5.25% and then 12 in 19 months, and they didn't plunge us into a recession. This is the most masterful thing that's ever happened in the history of mankind. It's unfreaking believable. Well, that's not what the interest rates are saying. So there was a point up until I would call it October, right? August, September, October. I was starting to question my own.
This year?
Yeah,
like
this year.
2 months ago? Okay.
Yeah. So 2 months ago, I was really questioning my own thinking about this and starting thinking, you know what? Maybe they did pull off the soft landing. And the reason for that is because the interest rate futures, the bond yields and the interest rate futures were more or less agreeing with the Fed. So Powell said, so if you go back several months, like say March, April 2023, the bond yields dropped a lot in response to the banking crisis when we had all of those regional banks shut down. I think there were 10 of them. And so the bond yields plunged, those 2 years, those 10 years that we were talking about earlier, by like 0.5% in a week, which is a lot. Okay. So the average movement.
That's the rate. So the price was moved a lot.
Yeah. So the average movement, by the way, for these types of bond yields is like 3 to 5 basis points. So 3 to 0.05% in a day. Right. So that's the average.
So this is 50 basis points.
Yeah. So it's quite big moves. So around this time, and then you've got interest rate futures markets, which are doing the same thing. So an interest rate futures contract allows you to bet on the direction of the federal funds rate. Each one of these contracts has a rate that is implied by the price of that contract. And so people look at those futures contracts in order to, and there's several. There's one for the secured overnight financing rate. There's one for Fed funds. There's one for, there used to be one for LIBOR. LIBOR's not around anymore, but there's a bunch. There's ones for all the European interest rates. So there's futures contracts on all these rates around the world. They're all doing the same thing. So they're plunging. Powell keeps on raising rates. The Fed keeps going up. They keep going up. They keep going up. They hit 5.25%. Eventually, he does what I can describe as, maybe this is not exactly what's going on, but the Fed seems to have bullied the market into agreeing and just saying, no, rates are going to be higher for longer. So that's the message that the Fed has tried to send for the last year. You're not getting rate cuts. You're not getting rate cuts. Shut up, you stupid hedge fund mofos. We're not giving you rate cuts. Stop asking for heroin. This is not going to happen. And it looked, like I said, August, September, October, the 2 year, the interest rate futures, they were pretty much in line, a little bit. Well, let me look at the charts are in the paper that's going to be distributed. So you can see for yourself how the Fed's outlook compared to the market's outlook. But the market's outlook had moved up and moved up and moved up. And I was thinking, wow, okay, whatever we thought was about to happen, maybe is not about to happen. Maybe the markets, the bond market has agreed with higher for longer. Okay. People are not flying to safety because we don't see those yields tanking anymore. All this kind of stuff. Okay. So
I'm looking at your charts.
Yeah. I was trying to get an idea myself. So call it the end of October. I'm thinking, okay, maybe soft landing is really in play. But problem is, I got a couple of other or at least one other indicator that I'm going to touch on as well. Problem is, what's happening in China is systemic and it's global, and nobody, I don't think, is immune to that. So in mid to late October, everything that I just talked about. So just think about it as the 2 year bond yield. And then let's say the Fed funds futures contract for December 2024. So about 12 months in the future, right? those start to go the opposite direction. They're moving up, they're moving up, they're moving up. And at that point, I'm saying the markets are agreeing with higher for longer. The Fed has bullied them into submission. They're not predicting a recession anymore, right? We could very well, the yield curve has been inverted for like 18 months now, right? We very well could have a yield curve that is no longer inverted. Maybe this really is a soft landing. Okay, mid to late October, all of that plunges in the opposite direction. And then crude oil prices do the same thing. Okay. Crude oil prices, they go up and they go up and they go up. And this is at the same time as a crisis in the Middle East, right? To the moon with that kind of stuff. They don't. They go from 87 one week to 75 the next week. And they've just been languishing and range trading ever since. Okay. Crude oil is a big, pretty straightforward indicator of economic activity for
leading.
Leading. Yeah, for sure. Absolutely. Okay. Around the same time, the connection, yes.
Sorry, I don't want to interrupt your train of thought, but I read, maybe it was William Engdahl, I can't remember who, said that the single most important indicator of any kind, and I believe it would be a leading indicator, is steel.
Mm-hmm. Yeah,
So, and I think that's
interesting
interesting because it's so real. Like energy, oil is what you use to manufacture, but steel is infrastructure.
Yeah.
Okay.
Yeah, I mean I would agree with that.
Think about. Keep going.
Yep. Let's look at what steel prices have done.
You must have notes because I get to interrupt you and you still pick up the thread, so that's good. And I have another question that you're gonna have to get to, but I'll let you finish.
Okay. Yeah. In October, so the rates turn around in October. So since then, let's just call it since the end of October, the 2-year Treasury yield has dropped from, I need to expand this so I can see. It's at least, what is it? Okay. So 5.25%. So that's right where the Fed is, no longer inverted, at least at the short end of at least with the short rates. Okay. So that's right where the Fed is, 5.24. in mid-October 2023. Now we're at 4.6. Okay, it's tanked in a few weeks.
This is okay. So this is the Fed funds rate.
This is the 2-year bond rate.
Oh, okay, because the Fed funds rate is the thing they set.
Yeah, Fed funds has not dropped. Fed funds has not dropped.
Right.
That's
okay.
right. Yeah, so this is the 2-year bond rate.
So the spread.
The spread
has changed a lot.
Yeah. So now you have not an inversion, not a yield curve inversion between like 2 years and 10 years. You've got one between overnight and 2 years. Right. So that's meaningful.
Right. Okay.
Right.
You have an inversion. It's inverted.
Yeah. It's inverted, and it's inverted at a really short interval. Like I said, overnight to 2 years.
Okay.
And then same time, so end of October or mid-October, end of October.
So wait, that makes me feel like recession is imminent.
Yeah, and I'm actually thinking that because of recent employment numbers, I think it's already here. I think that when the National Bureau of Economic Research does their dating thing that they do, they're probably going to say it was the second or no, they're probably going to say it was the third or fourth quarter of 23. Yeah, because well, I don't have to wait on that. So if you look at this is not usually talked about, but the U1 unemployment rate is just the percent of the civilian labor force that's been out of work for 15 weeks or more.
And the labor force is defined by people who want to work or people who can work.
People who are actively applying for jobs. So it does suffer from that, BS
stand that
thing that I hate it. Awful. Yeah. So so the U1 is usually much lower than the unemployment rate. So like in April of 2023, it was 1.1%, while unemployment was 3.5 or something. Okay, but this indicator, this rate never turns up unless you're coming down already from a peak. So you're coming down the mountain. It never turns up off of a low without it leading to a recession, without it next going higher. So it bottomed in basically March 2023, April 2023 at 1.1%. Now it's up to 1.4 as of September.
That
or October, excuse me.
Very fundamental measure of unemployment is
15 weeks
rising.
or over. Absolutely.
Okay.
Yep. The unemployment count, according to what's called the household survey taken by the BLS, is also going up gradually, but it's turned up. And then the other thing that you have to think about too is that when you get closer to a recession or you're in one, there's data revisions with all of these releases. So if you look back in the chart, you can see very clearly, oh, unemployment went up in September of 2007 and or December of 2007, and the NBER said that the recession started in December of 2007. Well, at the time, you may not have actually been able to see that because the data was inaccurate, right? Because when you look at these time series, if you go and pull the data, that's taking into account the data revisions that happen later, maybe 3 months, maybe 4 months after the first print is released. The tendency when you're in a recession is for the data revisions to come in lower than, as opposed to higher. So on average, the data it's going to be evenly dispersed around whatever number was there before. So the standard error or whatever you're gonna have some that come in lower, some that come in higher, blah blah blah. Well, in a recession, it always tends to be lower. So whatever the job gains were, it's going to tend to be lower. Whatever the unemployment rate is, it's going to tend to be
Higher.
the opposite. It's going to be higher. Yeah. So that's the other thing you have to think about is that if you see an ever so slight upturn in unemployment right now, that could look a lot steeper in
Right.
3 months when the revisions come out.
Okay. Uh, is this a good time for me to say a bunch of stuff?
Yeah, sure.
Okay. Um, I
I do have to mention China, and it'll take like 5 minutes, but yeah.
yes, let me get through this fundamental stuff and then let's do the China thing because okay. I This has always been my problem. Like I can't separate like the theoretical stuff and like my cynicism about the news and my analysis of propaganda from what's actually happening in the market. So I'm just going to give you my like propaganda analysis and all that. So I looked at the COVID thing and I was confident that I've definitely mentioned this to you like 3 times already. I saw like interest rates were near zero, 11 years into an expansion. I was like, this doesn't work. They always cut. If you look, I looked at every year there was data, like every 10 years, whatever, for like 100 years, or since the beginning of the Fed. And every single recession, which was basically a 10-year business cycle, they
Mhm.
lowered rates by 5%, percentage points. So I thought they basically went from 7% to 2%. Like 2% was the lowest it ever got. Now, so I was thinking, well, they have to raise rates they were saying 3 3/4 was like they're definitely raising them to 5. And
Mhm.
historically they really should raise them to 7. Now I realize that their bottom line is not going to be 2%, it's going to be 0%. They had to get it to 5, but then they're going to bring it down again.
Mhm.
So are they like this isn't really a question. I'm just going to say this and then I want to say something else. Like, so now I'm thinking, are they going to just like turn around and bring that back down again? Like, are they worked that it took them so long to reverse ZERP or whatever, like no more interest, zero interest in perpetuity. And then I was thinking, well, maybe, I don't give them credit for a soft landing, even if they don't get a recession, because we had a recession. COVID was an artificially induced recession
Mhm.
during which inventory was worn out, was blown off,
Mhm.
and jobs were cut. And I mean, massive. Like it would probably be the worst recession in U.S. history. So, given that that's what a recession is for, why isn't it possible? I'm not going to say it's a soft landing, but I don't understand why we need a recession. And then maybe you can tell us what is a recession and why do we care?
Mhm. Yeah, I would say that the difference between what happened in 2020 and a recession that is, call it more organic, is that so the problem with the COVID recession is that there was no deleveraging, right? And by deleveraging, I mean the
Right.
defaulting and the liquidation of debt. So even in the fallout from the GFC, when you have all of these bailouts and you've got,
Okay.
the Fed is buying all these toxic assets and everything, you still manage to have a reduction in what we talked about before, that private debt to GDP ratio, the
Mhm.
private debt to the production, the amount of production in the economy over the
Mhm.
course of a year. You still had a reduction in that ratio from 175% down to like 140. It was actually somewhat large in the United States. Didn't get down below 100,
I
right?
mean,
Like it
that's
probably
actually
should.
the problem. That's actually been the problem for 20 years is that
Is
they
that
did
we
not
won't get below 100. Yeah,
they
we don't
didn't
allow
let
full deleveraging.
yeah, they didn't let the debt implode, which is why what you would have had was a deflationary collapse, which is something
Mhm,
like it's hard for me to get my mind around like what's deflation, but you have to understand it's a debt-based currency in order to understand the possibility and the devastation of a debt of a collapse like that.
mhm.
So that brings me back to something I've also said to you at least 3 times, which is so now you have all of this inflation, which it took 20 years and COVID to justify, and
Mhm.
that is inflating that collapsed debt without actually having that creative destructive process. And so now I would say, okay, you said we didn't have the deleveraging, but if you look at it that way, the debt is actually way lower unless it's like floating rate debt or whatever. It's actually way lower because all of a sudden you've halved the value of the principal by having a lot of inflation.
Yeah, you could say that if the value of the principal had been cut in half, but I
It
would,
has not.
right. The post World War II inflation was enough to really reduce it. The issue is that even with the inflation, it's still been piling up.
They keep borrowing. That's
Yeah, yeah,
why.
yeah,
They're
yeah, yeah.
borrowing these new dollars.
The debt load,
Yeah,
the
and the
credit
interest rate
expansion,
if they had short-term interest, if they had short-term loans,
they're having to roll
they're
it over
replacing those
at
loans
higher
with
rates.
super high rate, and that shit will pile up. You ask
Yeah.
anybody who had, being that I came from a really broke background, when I went into, after I got out of school, even though I got scholarships and everything, I was living on credit cards. It was
Mhm.
like 20%. And I remember the gal, I wish I knew her name because she was so nice. An older banker, and older bankers are not nice, right? So she was nice to me and I'll never
Mhm.
forget her. But she said, pay off your credit cards. The difference between paying interest, big interest like
Mhm.
that, and earning, because this was still, I'm not going to tell you what year, but a really long time ago where like 2% was not a normal interest rate. You could make more than that.
Yeah.
And she said, like, the delta will blow your mind. Like, get your
Mhm.
debt under control. And she was right. So
Good advice.
people underestimate the impact of that kind
Interest.
of interest and it when it
Yeah.
compounds monthly or whatever, like on your credit card. So
Mhm.
I can see, right, they're not getting out of the problem, but that's, wow, oh, that sucks. Well, you answered my
There's
question, but I don't
there's a
like it. I
reason.
don't like your answer.
Oh, yeah. Well, there's a reason that the acid test, right? There's a reason that the acid test on the in stock valuation is current assets and current liabilities, right? That current liabilities is literally your interest expense plus any of the principal you might have to pay off within the next year. But most of that debt obligation, most of those debt service payments are just going to be interest, because a lot of these
Mhm.
corporations they borrow for
Right.
5 years at a time. I don't know what the average corporate bond maturity is, but I'm pretty sure it's in the neighborhood of 4, 5, 6 years rather than 6 months.
So my thing was high yield. Did I tell you that? I was a high yield bond investment banker.
Oh,
So
wow.
I worked for the guys
You were in
who
the zone.
left Drexel. I was the only chick, which is basically the reason I was just like, "Oh, I love being the only chick. I'll take this job." And when I got there, they said, "Are we?" I had one like kind of rabbi who got me into the group, and the other guy was like, "Oh, are we gonna have to start watching our mouths?" And and the guy who got me in there's like, "She's gonna have to start watching her mouth." So it was definitely rough and tumble,
That's
but it was
funny.
the old Drexel guys, and I don't remember anything, but I do to the extent that I did anything, it was these high yield bonds, which, would be like 10-year, 15-year bonds. Yeah.
Yeah, and Drexel Burnham Lambert, those guys invented it.
Oh, yeah.
Yeah,
No,
that
they
was
were hardcore.
they
I worked
created
for
it.
guys who, even till I left the company, they were still getting checks from like they had a private equity fund within Drexel. Like these guys all put their money and that stuff is like super tax advantage and everything.
Mhm.
Even now, I still every once in a while will get a check from something I invested in, just the firm be like, "Oh, we'll give you the money, like a non-recourse loan." And I mean, it was just tiny because it was me, but the Drexel guys had some serious like residuals. I remember
Mhm.
they were that was the go-go. I wasn't there in the go-go 80s. I just saw it in the rearview mirror,
Right.
but
You
those
didn't,
those
snort
guys were the
cocaine
shit.
off of any breasts.
Right. That was the thing that the coke heads ruined. Like they brought, I'm sure it was the M&A guys because they had to stay up all night. And their expectations that you could work 2 or 3 days without sleeping, just
Yeah.
if you're trying to do that on Starbucks, you get violently ill. If you're trying to
Yeah,
d you're
true.
trying to do it on grade A Coke, that's a totally different story. Anyway, I was in
Right.
the Starbucks era, and it just I don't know, it burns you out.
Literally, because that's a lot of acid for your stomach. I mean,
Dude, and I
drinking of
remember
coffee
being
and
like,
it's
"Wow, you guys have free Starbucks? That's so awesome." And then, like 2 6 a.m.s into, an M&A deal, and I was like, "I get this free Starbucks now." Like, you
yeah.
it's like the Blitzkrieg, didn't Hitler give them a speed for the Blitzkrieg? It's like, yeah, that wasn't a favor to you?
That was for me, yeah.
Yes. Anyway, yeah, I don't know if freebasing increases your productivity. I'm not sure there's freebasing, but I definitely saw little razor lines on stuff. Okay. So I hope this isn't the family audience, like what kids would be listening. That's the beauty of it. It's like your natural rating is like there's no chance in the world there's a kid listening. Okay,
Right.
so I'm glad you told me that. I wanted to add just two more things. So a recession, just by the way, is what, like 2 down quarters in a row or what?
Well, we had that in 2022. There were two negative quarters of GDP. They didn't declare it a recession. So ultimately, the way that you can think of it is there's less stuff being produced, and there's a couple things that the NBER needs to see in order to declare one. Not only
Mm,
does GDP have to
okay,
decline, but you got to have a rise in unemployment and you got to
got it.
have a lowering in industrial production. And between those three things, if you see those three things coincide, then they'll call it, they'll call it one.
Okay.
It's funny because if you measured a recession as a decline in GDP per capita, we would have actually been in recession for like 25 out of the last 50 years.
Oh,
So
wow.
yeah, I
That's
looked into that one time.
fascinating.
Yeah, I looked into that one
Wow.
time, and that's kind of, yeah.
Wow. But you can then think like what you're doing, if you are personally experiencing a rising standard of living under those circumstances, what you're
Hmm.
saying, and this, I think, I read this book Against the Grain. I don't know if you've ever read this by James Scott, a Yale professor, and he just goes back to like the beginning of time, and he says that like since the beginning of a civilization,
Hmm.
all cities uh, burn out their workforce. They have to get work from immigration. They just eat people. so what you're saying is if you're experiencing a rise in living standards under these circumstances, it's because of the immigrants making much less than their living standard. There's probably a big gap between people who are born here and went to like say high school here or college here and people who are immigrants in living standard. But I would
Ooh, I don't know exactly what to make of it.
I mean, I'm saying that's my explanation for what you're observing because I don't feel like
Well, if you just think of, yeah, that could be it. If you just think of GDP, like what is GDP? It's the dollar value of all the stuff that's produced, all the new stuff that's produced in the economy in a year. And so the per capita GDP is just the dollar value of new stuff per person in the country. So to me, if what you're really measuring is standard of living, that means more stuff. If it's a good increasing standard of living year, if it's a non-recessionary year, if that's how you're measuring it, then that means more new stuff in the year per person, right? To me, that's what
right. And
increasing
I'm
standard of
saying
living means.
if if you're saying that that's been going down,
Oh, I know. I was just saying in general, if you look at the last 50 years and there are many, many years where GDP increases, but GDP per capita does not, right? Like the
Right.
amount of stuff goes up, but the amount of stuff per like the population increases more
Yeah, no, I get what you're
than
saying, but
okay,
I'm
okay.
thinking, but I'm saying, I bet if you took one more pass at that data and looked at the standard of living for people who were born here,
Hmm.
like if you took GDP, if you took consumption by people who were born here,
Hmm.
divided by the number of people who were born here, the
Hmm.
dollar value of that would be increasing.
Yeah, probably.
And then
Yeah. I
I'm
mean,
just
because
saying, and
it's
I'm not making a social comment. I'm saying
no,
that's
no, no,
why
no,
we
not at
always
all.
have immigration. That's what it's for. And then those
Yeah,
immigrants, their children are in that category. My
yeah.
grandparents were immigrants.
Because
So
the
yeah,
denominator is population, and that number is going to be influenced by your immigration
right.
rate.
I mean,
So
that's
yeah,
what
yeah,
it
yeah.
is
That makes
because
sense.
we
Hmm.
don't have the birth rate.
Yeah.
However, but I would just make the further comment that doesn't mean that the even if the average standard of living is going down, the voter standard of living might be going up.
Right. Right.
And that's what they want. So maybe, but if they
Yep.
loved us,
Yeah. I just
or
always
even if
thought
they
it was
want to exploit us.
interesting. Yeah. I just always thought it was interesting that if GDP is supposed to be the standard of living measure, why don't we, when you compare two
Yeah, I
countries to
agree
each
with
other,
you.
you
Yeah,
don't
it's
use
smart.
GDP, you use GDP per
Right.
capita. So when we measure whether or not we're in a recession, why don't we also use GDP per capita?
Yeah, it's smart. I'm sure there's a reason for that. One thing, if you ever felt like doing research on demand, one thing that I've cited because I did just quick and dirty back of the envelope, but the 19th century, I am very interested in real wages
Hmm.
and like CPI or whatever. Like I my argument is that productivity gains were captured in part by labor in the 19th century,
Hmm.
but not ever after Keynesianism was introduced, because I believe that is the purpose of Keynesianism, if you know what I mean. So Keynesianism is there, in my opinion, to inflate away, more than inflate away, any wage gains,
And keep people
which
spending.
right. So they Keynes wanted capital to absorb productivity gains 100% and give
Mhm.
labor the impression that they were absorbing some of the
With the
productivity
money
gains
illusion.
by
Yeah.
yes. So that's why I feel like if you did 19th century and then, 100 years ending in 1900 and the 100 years ending in 2020, I think that would prove that point, but it's not your
Yeah,
job.
well, I think we touched on the 19th century in maybe our first episode. So you
Yeah,
you
but
did
that's just
see
a
that the
specific that I
yeah, yeah,
really,
yeah,
if
yeah.
you stumble upon it, I'd like to see it because it's actually a little
Mhm.
tricky to get, because I was trying to figure out like the price of milk in
It would
1800, the
be.
price of milk in 1900, the average wage for something in 1800 versus 1900, and I feel like standard of living was rising in a free market. So that's what I'm
Yeah.
saying. Like this, I only bring that up because I was suggesting that you need immigration to allow standards of living to go up, but I'm only saying that in this system. I don't think that's a real rule.
In a highly inflationary system, you
I
need it.
Yeah, and
You
that's
need
what
somebody to
Keynes
be
gave
making
us.
a really, really low wage. Is essentially what yeah, that
Maybe,
makes
yeah.
sense.
So I'm just there's some idea there. The last thing I wanted to ask you before we move on to the China issue, and then I'm going to let you go because you're so tired. Not tired. You've been working so hard recently, and it was very nice of you to come on. But I'm not going to keep you on for 2.5 hours like I normally do. Um,
It would not bother me a bit. Trust me. We
really,
can go as
it's
long as we need to.
enervating. Okay, so here's a big question. So you said that unemployment has to go up or is going up. Is inflation, from what I read in the Wall Street Journal, which I basically don't believe, but it does say inflation is going down. And I think it actually said that the price level is going down. So if someone says inflation is going down, that to me means the
The
rate of
rate of
inflation.
change.
So
Mhm.
so yes, you're still going to pay a dime more for everything. Um, but it'll only go up a dime every other month instead of a dime every month. But if he's saying that we're stabilizing or even paying a dime less, next year, I think that's almost impossible. Is that something that you're looking at in a way to gauge even really what the Fed is going to do or what we're looking at? Because the Fed says that's what they're looking at, but
Yeah, yeah, and then the thing about the Fed is they all, they talk about PCE, personal consumption expenditures. That's their index that they like. But if the CPI looks the way they want it to look, then they'll talk about the CPI and they'll react to the CPI, right? What's going on right now is that in general, the article that you sent was durable goods, and the Wall Street Journal was
Mhm.
commenting on the fact that durable goods prices have decreased, which is accurate, at least according to the way that they're measured. The general index, so you take consumer good, which is cars, washing machines, ovens, appliances, probably microwaves, stuff like that. Um, which to me, houses are just a durable good, right? But that's a whole different discussion.
Yeah, right.
They're not an asset. Like, I'm sorry, they're a durable good. That's all it is.
Oh,
Um,
yes. Oh, that's such a great way of thinking of it because I
yeah.
always try to separate the value of the land from the value of the house.
Hmm.
I'm always when I look at something like that, it means nothing to me. I need to understand, like, you peel the house off, and you'll try to get a realtor to do that, and she will not do it. They will
Nope,
not do it. And I'm
won't do
like,
it.
that's the fact. That's what we're talking about here.
Exactly. Yep, they won't do it. Exactly. Yeah. No, and it should like that should be part of every realtor's
It
I
would
don't know,
change
just
the
how they
way
talk to their clients,
stuff is
you know.
marketed, because yeah, because the house, land is special. And
Yep.
houses are not. My house is special because it's old. But I have a couple of questions for you here from the viewing audience. Do you expect a downturn in the stock market or do you think it will be flat? What is your personal view? And no, it is
So
don't run to the bank on this. We don't know this guy. I just met him like 2 months ago. So
right,
I have no
exactly.
idea if
Um,
he's rich or poor, if he makes money. I don't know. He shouldn't even if he's so good, why is he even talking to me? So
right.
go ahead. But tell us really, but I do think he's honest. So let's hear what you honestly think.
Yeah, so I'm actually getting the monthly CPI numbers because I want to make sure I'm accurate about this in a second. Okay, there it is. Okay, good. Let me take. Okay, whatever. All right, so I am do. Okay, so first thing, do not listen to what I say that I'm long or short right now, and then go do it, because I'm a trend follower. So my action changes based on the price. And if you don't plan to look at that price every single
Right.
day and adjust your decision, do
Right.
not listen. And you shouldn't even listen, even if you do want to look at it every day, because you don't know what rules
You
I'm
don't
following. So just
Yeah,
don't.
I agree with
Um,
that.
if you want details, you can go to jpurcell.me, and I think there might be, yeah, just sign up for jpurcell.me, and you can also send an email to contact@jpurcell.me, and just let me know you're interested in that sort of thing. But I'm, as of today, short the NASDAQ ETF, the QQQ. Via I just bought some put options. And I do think that what's going on right now, as far as the stock market is concerned, is that I don't think that the economic correction is priced in. I think that the downturn that was seen between the end of 2021 and, say, early 2023, because right now what's happening is, if you pull up a chart of the S&P 500 or the NASDAQ or whatever, and you just take a look at it, we're basically bumping up against that previous all-time high. And the assumption there is that, wow, look at how far stocks have come. I mean, this year the NASDAQ is up like 40%, on the year, because it came down, because the trough was almost exactly a year ago, or so. So it looks like it's up 40% on the year. And so the assumption is, okay, soft landing, it's going to keep going, right? And that may be the case. Like I said, price is the only truth. I love macroeconomics, but I don't invest on macroeconomics because it gives you nothing as far as timing is concerned. Like, I went and back tested what would happen if you bought and sold the S&P 500 based on the shape of the yield curve, because yield curve predicts recession, right? Well, guess what? It doesn't work, right? You'd
Timing
be
is
better.
everything. I mean,
Yeah.
it just really is like you can be as right as you can if you don't have the timing, and nobody really has the timing. And I
No.
would
Yeah,
even
nobody does.
say just buy now and hold it for 20 years, which is what Warren Buffett says. But then I look at Japan and I'm like, well, there
Yeah.
are paradigm shifts every once in a while.
Hmm.
There are turning points.
Hmm. Yeah, buy and hold would have been a horrible strategy all the way, from 1991 all the way until 2015, I think is when it started to turn up again. That's insane. So and it's not terrible on its face to buy and hold, but there should still be a reservation price at which you get out, right? Like if you had been invested in Japan and you were a buy and holder, that's fine. You could have, at a 20% correction from that all-time high, it's fine to assume, okay, this is going to turn back up eventually. But when you're down 45% from the all-time high, and the economy's in the toilet, it's like, buy and hold has really only worked for one stock market, and that's the United States. If you
Wow,
go back like
interesting.
150 years. Yeah, it's not,
I
they're not all like that.
personally, I feel like the absolute, I mean, this is just me because I'm risk averse. I just feel like, and Dennis Miller said it once too, is like pay off your debt and then buy things you need. And that is what I told my
Hmm.
husband once. I was like, we were renting and renting, and it's just so wrong for someone our age to rent. But when we moved to LA, it's like it was just impossible to get into that market and buy a
Really
house.
hard. Hmm.
Not sure you're gonna stay. And I made him just buy a little place somewhere that we could, if we had to live in retirement, we could. And in the meanwhile, Airbnb it out, because I was like, look, you have to have an asset in kind, like the kind of asset you're going to need is a good way to think about it. So if you need a place to live in your retirement, maybe invest in Florida real estate or something like that. But like just
Yeah.
have what you need. And my husband collects wine. So I'm like, hey, you got three square, 3 squares and a cot and wine. Like that's all you need. Like you don't need anything else. And I feel like that's just a good way to like start your baseline. Gentleman Skeptic says stack silver, invest in seeds, land, and lead. I mean, that lead seems to be a pretty good investment, man. There is always a shortage of ammo. I almost wonder if
Hmm.
part of why Sweden is joining NATO is I think they make ammo.
Oh, really? Yeah,
I
that
I
very well
think
could
so.
be.
I
Well, if that's the case, I would
Nobel.
like if they could like cut whatever tariffs on that and make it a little cheaper here. That would be
Yeah,
great.
or have
Because
dibs. Just
yeah,
dibs.
yeah, because
Anyway,
ammo's gotten really expensive.
it
Jeez.
really has. Okay,
Yeah.
so keep going.
To give a solid answer on that though, yeah, I don't think that the fall in earnings, the fall in revenue, all that stuff that is associated with the recession, I don't think that that's priced into either the S&P 500 or the Nasdaq. I think that the correction that was seen after 2021 was in response to interest rates. So when interest rates go up, the value of a bond, let's say that you have a bond, it pays 2.5% every year. The current interest rates goes from 2.5 all the way to 5.5, or let's just say it doubles to 5. Well, the value of that bond goes down. Okay, that's a very straightforward relationship. It's very well known that bonds are that way. Well, guess what? Stocks are a long duration asset too, right? So they pay dividends. And ultimately, what are people who invest in stocks now? They're not really investing to get dividends. Like, I'm sorry, most people, it's the same thing as cars. When most
All
people
of
buy
my
cars, they're buying a
all of
payment.
my retirement stocks pay dividends.
Well,
That's
good,
all I
good.
buy. I can't
Yeah. I mean,
I guess I am
um,
risk averse.
yeah, that's great.
Well, it was doing
There's
well in like a zero interest rate. You know what I mean? Like it's a
mhm.
anyway, who cares?
But most people when they go and they invest in the stock, I'd say maybe 95% are not looking for dividend stocks. They're saying, put me in the S&P 500 or the Nasdaq or some combination of both, and let me buy and hold until I turn 65.
Yeah,
And then the plan
that's
is not
reasonable.
to collect dividends; it's to
Yeah.
gradually sell the
Yes.
portfolio over time.
Yes.
So
Of course.
you're betting. So you want price appreciation, but that price appreciation has a time element to it, and anything that has a time element to it is going to tend to decline when interest rates go up. So that's true for most assets. So that's why
Because the interest rate is
is your
basically a
opportunity
guaranteed
cost of having the
return.
asset.
Okay,
It's the interest rate is your opportunity cost of
right.
holding a long duration asset
So that's
because
why ZERP created a stock bubble. ZERP is
yeah.
zero interest rates in perpetuity.
Hmm.
So when nobody could get any money in a bond, which would tell you like this is this risk, it's like an triple A rated, this is the
Uh-huh.
interest rate you're getting, you know what you're getting, and it's a very straightforward thing. When that
The
you
reach
know
for
what you're
yield.
getting is zero, you
Mhm.
have to put your money someplace else. And I think that's probably part of why they do it.
Yeah. No, it is. And even, I mean, Ben Bernanke said that himself. He said, we're trying to juice the wealth effect. So when people's,
Jerk.
portfolios go up, then they'll feel more
Douche.
comfortable spending. Yeah, absolute douche. Totally. But yeah, that's exactly what he's saying. We're going to use the wealth effect. Okay. Well, what does that mean? The wealth effect is people feel more wealthy. Well, how are they going to feel more wealthy? Well, the stock market's going to go up and then they'll feel more comfortable about spending. And since we're all Keynesian economists and we believe that spending is the truth and spending, consumer spending drives the economy, that's how these people think. They're like, all we got to do is get people
See,
psychologically primed to spend, and then we'll be out of this. That was their
this
whole plan.
this upsets me because who benefits? And one of these guys in the chat was saying like it's just the brokers benefit from the stock market more than anybody else. I don't know. I mean, stock market does go up, and it
I don't
seems
know.
to
I know some people in their
who
50s and 60s who have really benefited from some,
the
from some.
fucking boomers. They get it all. I'm a buster. I'm Generation X. I get nothing, nada. But yes, there are people who make big money. But what bothers me is, and this just bothers me about stimulation, about infrastructure, about investment, about suppressing interest rates, about giving tax deductions for uh like real estate, which subsidizes like tearing shit down, wars for oil, all of this stuff, all of it is subsidizing consumption.
Mhm.
And we're human beings. You know what I mean? I'm a creature composed of body and soul, made to the image and likeness of God. Like I am not just a fucking maw, that
Mhm.
someone needs to shove stuff in. And they only
Mhm.
want to shove stuff in my maw because they know that every time I lay out, you know, paper money, they're going to take one off the top. And,
Mhm.
and they can't do that if what I do with my time is grow food, cook it, teach my kids how to do the same. Like if we're doing all that stuff that's completely without that financial element to it,
Mhm.
your life is so much richer, but they can't get anything out of that. And the fact that, when we participate in the stock market, which of course, like I want to, I've been working my whole life. I mean, I am at home, but my life is based around my husband's economic activity, which is totally outside the system. It's totally, financial oriented, money based. Like none, it's just he gets paid for working. That's it. There is no vig. He doesn't get a piece of the action. And but I just feel like they've convinced us all because we get that return. You look at it and you think like, oh my gosh, my 401k is up. You get
Mhm.
so much satisfaction out of that. Like even if your stock goes up one day, you get a dopamine hit. And it's so hateful because it's
Oh,
like when I start to think about uh it- I hate to even say it because I'm American, but like the separation of church and state thing, I feel like there's an I'm such a libertarian, I can hardly choke out the words, but, like, we're
go
not
for it.
just
Say
economic
it.
beings, like, we have souls and we have community. Community is what we are,
Mhm.
and family and church, like, we need to like, this system is like, they've totally monetized the human soul. It makes me sad.
Yeah. Well, that's why I like Adam Smith's theory of moral sentiments is as important, if not more important, than the Wealth of Nations. I'm not going to pretend that I've read them both because not exactly page turners,
Well, what
but
is it though? What's in
know.
a nutshell? The moral I've never even heard of that before.
No, so it's Adam Smith's. It's his more philosophical work on. He says things like man desires not just to be loved, but to be lovely, right? People want to not just have things and consume, but they want to be good and they want to be admirable beings, and so it's a lot of
Yes.
those kinds of ideas. Yeah. So
Yeah,
Adam
that's
Smith wasn't
absolutely
just
true.
the yeah, so people pin this whole like economic automaton, Homo economicus species that the economics profession has, supposedly turned us into or whatever. People blame all that on Adam Smith, and it's like that was not Adam Smith's take at all. He was a very well-rounded philosopher. He wasn't anyway.
Interesting. And I was
Yeah,
kind of throwing him under the bus recently because
because you had
I'm a
Courtney Turner on the show, and she
I
was
know.
talking about Smith and Hayek. Yep, I listened.
I'm a little off on the whole Enlightenment. I used to love it. I was a big fan of the Scottish Enlightenment, and then I just started to like, oh, those Gnostics. I don't know, man. That was the beginning of the end of my fantasy of like this having leaders who love us. I just think society is probably just too big. It's just too freaking big. 350 million people or whatever is just too many people to
Oh yeah.
they don't love you. They can't love you. You can't love them. That's why I don't even care about like when there's like mass tragedies or whatever. It's like, I'm like more worried about my dog is sick.
Yeah.
Like I'm literally like more worried. Not that I love dogs more than human beings, but it's impossible for me to care about something so abstract. Likewise, the
Yep.
politicians cannot care about me at all. They cannot. And but look, when over the decades, it just turns into a horrible monster. Anyway, but
Yeah.
that's not to say that I'm negative or down. I just think it's important to point out like these things we talk about, they do leave out something much more important. And so these guys talk about like all we care about is juicing the economy, but whatever.
With spending. Yeah, and there's certain swaths of that society that don't benefit when you just invest the time and the energy and the money to invest in yourself, right? So things like anything that's entrepreneurial driven. I totally mispronounced that word, but anything that's self-ownership driven is like it doesn't find its way, at least not as much. The dollars don't find their way to the same things as me working for a Fortune 500 corporation and spending all that time and energy in that. Because people, they want to get certified when they're on the corporate treadmill. They want to get a certification, they want to go get a master's degree so that they can get promoted. And it's like, yeah, well, all of this time is still going to this Fortune 500 corporation that you're easily replaceable and everything. The time that you spend, that entrepreneurs and people who are just like, one thing I started doing recently is actually working part-time for a roofing company, because I had to get a new roof and I liked what they did, so I wanted to learn about the roofing business, so
Yes,
I just
excellent.
yeah.
Cool. You get your
So
vitamin D, drink some buttermilk. Are you
okay.
up on the roof or are you doing their books?
No, yeah, I've got to get up. Unless you have a drone, you get up on the roof and
Well,
look for
I'm just,
damage and things
I
like
mean,
that.
if it's a big enough company, you could be doing the books. But
Yeah, yeah, true. Yeah,
no, you want to learn how to do things. I absolutely love that. I love that. But if it
yeah.
gets too hot, they roofers always just drink buttermilk. Did you ever hear
Oh,
that?
okay. I didn't know that.
Yeah, because of
Yeah,
the
so it's not.
tar and everything. Yeah.
Yeah, so it's not the same thing as being a roofer. So I will never install a roof in my life. Just sales, right?
Right. Oh, just
Yeah.
yeah, that's what I am asking. Like I'm
Oh,
asking,
okay,
are you
okay.
just learning how to do stuff? I always send my son to
Hmm.
do stuff. He's going to college, but I'm like, hey, go to a farm, go work on the truck and
Yep.
yeah, so
Yeah,
he's
do
got to learn
something.
how to do stuff. Yeah.
Yep.
Super cool.
That kind of stuff that doesn't serve the churn, that doesn't serve the system,
Right.
because that company, there's a million roofing companies in DFW. This one's a really good one that's been around for a really long time, but that's never going to be an avenue, that's never going to be a domain that the Amazons of the world are going to be able to take over, so
Nice.
it doesn't
Yeah.
serve them. So.
Interesting. Okay. Well, that's very hopeful. I like that. Right? I mean,
Yeah, I think
that
the
means there's
arts.
something for us that we can do. I always thought we should like I thought like the future would be us, whatever, giving massages to each other and everything, but I'm not.
Yeah,
I
there's that too.
think that's something that we
Teaching
could
the
do.
arts, you know, the
Yes.
dance world, that's never gonna be
Oh,
the avenue of Amazon,
how was
ever.
your dance competition over the weekend? Were you in it or were you just watching it?
Yeah, so I was in it. I I got where I wanted to be. So I wanted to be at least third, and I wanted to be on the podium. So if you're top five, you're on
Wow.
the podium. So I got third.
This was the
It
Irish
was
dancing tournament?
yeah, regional level, so Southern Region US.
That's so
So
great.
yeah, I mean, 10 years ago, I was a lot younger and I got first in my last one. But I'm content with where I was,
It
just,
was I took
having.
even though my Syrian grandmother has colored my skin, my,
Mhm.
Irish grandparents were super Irish. They're from Ireland, and we all took Irish dancing, and I just remember how fun it was. It was just
Yeah.
so fun because you know what you're supposed to do. You have the steps. It's not like, we're at a disco and, you know,
Yeah, that's
you
right, you
don't
don't
know
have to
what
make
to
it up.
do.
Mhm.
It's just so fun. You do it together and it's like so much energy and the music is great. And yeah, I just think it's super fun. I like to watch it, but I loved to do it. A little jig
Yeah.
here and there. But anyway, so
Yeah, it is a lot of
congratulations
fun.
on that, a little
Thank
achievement.
you.
But we have to talk about China.
Yeah, and we
Oh,
also
first of
have
all,
a listener who
yeah,
oh, we
Jack
Bitcoin.
Burton.
Yeah, yeah. So Bitcoin is behaving like a flight to safety asset right now. It's going up at the same time as gold does, and it's going up at the same time bonds do. This is not a realm that I ever imagined that we would be in. But like I
Hmm.
said a few minutes ago, the only truth really is the price, because you can't you try to make decisions based on fundamentals, and it's kind of like trying to control the behavior of millions of people who you don't even know. So what are you going to do? So I actually, I'm working on reactivating my mode of investing in Bitcoin and Ethereum and a couple of the other ones, because I've seen the rally. It's pretty substantial, and like I said, it's actually behaving like a flight to safety asset right now. So
Okay, interesting.
yeah, if we're in a full blown kind of systemic type of crisis in a few months, even gold will sell off. Even Bitcoin, even now, even though it's kind of behaving like a safe haven asset right now, it'll probably sell off. It'll probably correct, because the issue is that when you have a lot of big investment institutions with margin calls, they'll sell anything that they can sell. A lot of times that includes gold contracts, and even if people really want to hold on to their Bitcoin, it may include Bitcoin. So that doesn't mean that it's just to the moon from here necessarily, but yeah, I'm definitely getting back in. Not with a huge amount of my portfolio. I think I've mentioned it before, but I think crypto should be like between 5 and 10%. So
But you're looking to pull back on that in what time frame? You were saying it should ease off. You were saying
oh
those
yeah, yeah.
prices are going to back off. Are you talking about 6 months from now? Like the whole the Fed supposedly is going to start cutting rates in March or something, right? Is that right?
Yeah, it really just depends on how systemic this is, and I really don't know.
Okay.
But it's right now it seems to be pretty systemic, like globe reaching, but I'm just not sure. Again, my selling decisions are determined by what the price does. So if I get in and I lose more than my rule allows me to lose, then you're out, and you just look for the next signal to get back in.
And
That's
gains
how it
too.
goes. Yeah.
Okay. Interesting. But you're actively watching it. So when you say
hmm
like, okay, got it. So that's I
Yep.
just want people to understand that this isn't the buy and hold thing.
Right, right, right. Yeah,
Right.
yeah, yeah,
Okay. All
exactly.
right. So China,
The
you
only
talked
thing
about
that
the
I do
global.
buy in
Yeah.
gold
Uh-huh.
is physical gold and silver. That's what I buy and hold.
Okay.
So
Well, I do that too.
yeah, and
Aviva
land.
wants to know about Erie roofs. Do you even know what that is? I do not.
Um, no, no, I don't know. I'm pretty
All
new to
right.
that business. I just started about a month ago.
Oh, okay. Well,
Thank
we'll
you,
ask you
Aviva.
that
That's very
question.
nice of you.
Yes. Congratulations. Aviva is
Thanks.
a lovely artist in her own right.
Oh,
Um,
cool.
yeah, super cool. And anyway, so if you would then tell us about the China thing or anything global you want to talk about.
Yeah. So I guess the missing puzzle piece to what we were talking about, maybe 20 minutes ago or so, is that what was the force that caused rates and oil prices, those kind of leading indicators, to go in the opposite direction from what they were doing. So we had, the 2-year bond is kind of, they believe higher for longer. The Fed funds futures market is saying, yeah, we believe higher for longer, sure, up until mid to late November 2023. At the same time as that's happening, so what's going on in China right now? They have a really, really big private debt load. And they have all of these empty apartment buildings, all of this empty real estate that's just been built and built and built and built. China has regimented growth plans. They target a rate of economic growth, and they will do anything to achieve it. That's what they do. The Chinese government will allow as much credit to be created as needs to be in order to make that GDP number what they
Okay.
want it to be.
GDP growth is what you're talking
Yeah,
about.
yeah. So I think they've been sitting at like a 5% target for a
Would
long time now.
would building
Now,
empty buildings juice GDP?
yes, it
Oh,
does.
fuck.
Any
What
spending,
if
any spending
terrible
juices GDP. Any spending it.
so
The
when people
government could,
ugh,
yeah, the
for a
government
while
could.
there, they were encouraging us to look at like a command and control economy as something we should aspire to.
Yeah, so the government could literally borrow. Okay, so the size of the American economy is, let's say, I think it's 23 trillion, but to use like really nice round numbers, let's say 25. So which is not a round number, incidentally. But anyway, so let's say it's a quarter of 100, right? That's what I mean by round. So it's $25 trillion. The government could literally borrow $15 trillion and just spend it on thumbtacks, and that would increase GDP by however many 3/5. The GDP would go up by 3/5. They can spend it on thumbtacks. They could spend it on book covers that they would just leave empty and not even print anything on, just flimsy book covers, and then throw them into the Atlantic Ocean. There's a joke about the broken window fallacy, where if war is good for GDP, then this is Bob Murphy. If anybody has never heard of Bob Murphy, he's a really great economist. But there's a joke that he tells where it's like, okay, if war is so good for GDP, then every single year, what the government needs to do is borrow a crap ton of money. They should buy a bunch of aircraft carriers, and then they should sail this every single year. They should sail the aircraft carriers out into the middle of the ocean, get everybody off the aircraft carriers, and load the guns such that they can be automated, such that the triggers can be pulled automatically from a distance, remotely is what I mean. And then they should just destroy each other out in the middle of the Atlantic Ocean, sink to the bottom of the ocean, and then everybody goes home. They build more aircraft carriers. They do it all over again every single year. That would be the perfect economic stimulus package. Nothing could go wrong.
I
Right.
feel
So
like
yes.
a little bit that does happen. Didn't they say, like, during the Afghanistan war, like, they blew up the same caves, like, 5,000 times? Like, the same
Oh
cave
yeah.
was oh, yeah. So, like, even now,
Totally
every once in a while, I
surprising.
just feel like they're just the reason they drop 20,000 bombs a year on Syria is because they have bombs.
Yep. Yeah,
So,
because
he's not
Northrop
that far off.
Grumman isn't going to get more orders unless we use the
Yes.
bombs, right? Yeah.
But I think a bigger point is that we're still producing food and clothes, and we're not noticing that they're pissing all that away, of course. But
Right. Right.
yes. So
Yeah.
taken to the extreme. Yep, gentleman skeptic says, yeah, it makes sense. Build empty buildings, create jobs, keep manufacturing afloat. And so
Yep.
maybe steel as a leading indicator can be misleading because they're probably gobbling up all the steel for that stuff.
Well, and it's not necessarily misleading, because it's taken, right, like China has not officially had a recession or a banking crisis in, something like 30 years. So the entire time that they've been building up this massive debt load, it really, like, they have yet to really face the consequences for it. And we were talking about timing earlier. And if you have a command and control economy, it's really not clear when those chickens come home to roost, right? If the government can keep the credit tap flowing, and if they don't care how wasteful the projects are that they spend it on, it's, where does that really go? I'm tempted to think that it would be a collapse of the currency, because nobody would want to hold the renminbi anymore. I would think that maybe that's how it would how it would all transpire, and that would be kind of an inflationary collapse. But on the other hand, if you're coming down from a massive debt load, then that usually means, in fact, probably always means deflation. So, yeah, it's really hard telling. But what's going on in China right now in their financial market is basically a disaster. So in 2021, they started to allow their economy to deleverage. And anytime I say deleverage, I mean allow some of the loans to default, stop pumping out credit. And necessarily, when you're in a fractional reserve banking system, when you stop credit, that induces, you can't have level, right? In fractional reserve banking, you can't have level. Credit can't stop. It either goes up or it goes down. And the reason for that is because it's what Hyman Minsky called, economists from back in the 50s, 60s. It's what he called Ponzi finance. So you have to have the new inflow of credit to pay off the old debt. That's the only way a fractional reserve banking works. And when you have the credit tap turn off, it necessitates a drop in the outstanding amount of debt. Like I said, you just can't have level. So the Chinese government knew that there was a huge buildup and a huge unsustainable boom, or at least I think they did, in the real estate sector. And so they used their credit policy, their levers, to stop allowing the continued expansion of credit into that sector. So their two biggest development real estate developers, Evergrande and Country Garden, started to have a lot of financial problems around that time. So 2021 into 2022, that was a big story. Evergrande's bonds were trading around, So Evergrande's bonds were trading back in 2021. They were trading around, in May, I think it was, they were trading around $83 or cents on the dollar for those bonds. By the end of the year, they hit 15. Now they trade around 2. Okay. So China has all of these. China has a massive shadow banking system. So you have a regular banking system where you've got banks that take deposits and they make loans. A lot of those banks are state owned. A lot of those banks' activities are controlled by the state. Like I said, they have a lot more of these levers where if they want to juice credit in order to juice economic activity, they can do that. They also have this massive shadow banking system. So they have all these trust companies, about $3 trillion worth is about the size of the industry. And that's why I say it kind of mirrors the Panic of 1907, because the companies implicated in that crash back then were primarily trusts, not your conventional banks. Trust companies used to be really big in the US from like the 1890s up to, basically 1907, 1908. But they have a really big trust sector, and they have a really big sector of non-bank financial institutions. They sell to Chinese households, both wealthy and not wealthy, these things called WMPs, wealth management products. Now, a lot of analysis of financial crisis gets caught up in the details of these different products. That's why 2008, everybody thinks about mortgage-backed securities and credit default swaps. That's all a kind of an unnecessary distraction from the force that's really the gravity that's really underlying, which is you have credit expansion and then you have credit bust. That's the commonality between every financial crisis in history. There's always a credit expansion. The expansion necessitates the bust because of fractional reserve banking can't level. It can only go up or it can only go down. But the deal with these China's WMPs is they're literally just fancy time deposits that pay higher interest rates than bank accounts. That's all it is. So China's had really low rates for a long time, just like the rest of the world. They've used that because it's been difficult to stimulate their economy. They have not had a rate hike. This is the thing about China. They have not had a rate hike since before the COVID pandemic. So while all the other central banks in the world have increased their interest rates, theirs have been going down. So some of their rates are below 2% now.
Yeah. How far do they have to go? How much more could they go?
Yeah. So right now their 7-day rate is 1.8. So they can only get lower than 1.8. That's all they can do. That's all the room they have. So mid-October. So this has been, and think about this in the context of the peak of the housing bubble was July of 2006 in the United States. It wasn't until August of 2007 that we started to see the precursors to the financial crisis. And it wasn't until September of 2008 where Lehman Brothers collapsed, which is what people peg as being, like the start when it really, really got back. So that's 2 years. So we're 2 years into China's saga from, the collapse of Evergrande, from the beginning of the deleveraging to kind of everybody, well, not everybody, but people who pay attention to China realizing, okay, there's probably an issue in the real estate sector. We're 2 years out from that, basically. And now it's really starting to heat up. So what happened in China in October is their overnight funding market. So their overnight market where the shadow banks that I talked about, these non-bank financial institutions, they go in there to borrow money, and it's Ponzi finance, right? Maybe they don't have the actual organic cash flows from the business. Maybe the developers don't, in order to pay off all of those investors. But if they can borrow money from the overnight market, they can live to fight another day. Well, when that overnight market, or when that 1 week and 1 month, when those markets freeze up, like we talked about at the very beginning, when you see that LIBOR spread blow out for the United States in August 2007, same sort of thing. When you start to see that, and that's when those companies start to go bust, because if
That's
you
when the
can't borrow
music
overnight,
stops.
that's when the music stops. Exactly. Yes. And so that happened in China in October. And that is the turning point when all of these indicators across the world, it's not just us, it's Great Britain's bond yields, it's Germany's bond yields have done the exact same things as ours. So it's the bond interest rates, it's the interest rate futures, it's everything. The turning point coincided perfectly with the bad stuff that's happening in China.
So interest rates go down during. So the Fed lowers rates to
Mhm.
combat recession, but you're saying that actual rates start going down first.
Yes, in almost all cases.
That's
That's right.
interesting. Okay. I
Mhm.
never think of it that way.
Yeah. Yeah, and
Interesting.
yeah, so if
What?
you look back at any different financial, the 2008 is obviously a great and recent example, but the 2 year bond rate, the 1 year bond rate, even the 3 month, those start tanking long before the Fed
So
cuts
if
rates.
they hadn't ginned up the COVID thing and all the inflation that followed, there would have been a bloodbath, in my opinion. A bloodbath, because it, it was 11 years out in the expansion. Their
Hmm.
interest rates were 2%. Interest
Oh
rates
yeah, yeah, yeah.
would have had to go down, which means
Hmm.
that, they there would be. See, I can't get my mind around the fact that the interest rates go down first, because I would think when the recession is coming that there would be a tremendous demand for borrowing and interest rates would go up because you'd have
Hmm.
sicker companies,
Well,
and that's why the Fed lowers the rate.
but they do. You're
I
actually
can't
completely
intuit it.
right. No, no, no. You're right. You're right. So what
Okay.
happens is the money rates go up, the flight to safety rates go down, right? So when because that's like what we first talked about at the beginning of the episode. So LIBOR, that's the rate that a bank has to pay to borrow for 3 months. That is going through the roof. But at the same
Okay.
time, the 3 month bond yield, right, or the interest rate on the 3 month U.S. government bond is going to go down. The rate on the
So the
2 year U.S.
spread
government bond is
is
going down. The spread is going way out. It's just
is
getting this
widening.
blowout.
Okay.
Yeah, the spread is a total
Oh,
blowout.
I
Right.
understand.
Yeah.
Okay. So obviously the only game in town is the US government,
Yeah, or the
and you're
German
willing to
government,
pay
or
take
even the
nothing.
British government. Mhm,
Yeah, yeah, but I'm just saying you're willing to take nothing to get a
mhm,
piece of
to
that.
get that. Mhm, exactly.
Right. Okay. I
Yep,
understand.
yep. So the flight to safety rates, they go down, but all the other rates, it's basically the risk rates, the
Mhm.
rates
I
with
understand.
any counterparty risk at all. Yeah. The US government does have counterparty risk, but everybody thinks it doesn't, right? So we have to pretend that it doesn't.
It doesn't right now, I don't think.
Yeah, no, no. I mean, you can always, because they can always print. I mean, the risk is ultimately inflation, but that's a whole different conversation. But yeah, so
Right, but that just means it's actually a real negative rate,
yeah,
but it's not a risk of default. I would say right now
correct.
there's basically no risk of default.
Yeah, I agree. Yeah, I think
Okay.
Yep,
Fair
perfect
enough.
characterization. So
Okay.
yeah, the
So
rates
shit, now
with
you've got me
counterparty
like
risk go up,
I'm
and the rates
panicked.
with no counterparty risk go down. So October 15th, I think it was, the People's Bank of China, that's their Fed, they inject $100 billion into the market. That's their biggest stimulus since 2020.
100 billion.
It's nothing to us, right?
That's
But that's for
pish
them.
posh.
I know, yeah. But for them, that's their biggest stimulus since 2020.
But how can it matter? How can it make
In,
a difference? How could that possibly make a difference?
well,
Oh, because it's
central
their
banks,
Fed. Do they have
yeah,
fractional
yeah.
reserve banking?
Oh, yeah, of course they do.
So is that going directly to the Fed level?
Well, I believe the way that they do it is they inject it into the repo market. So those overnight loans, so
Right.
they put it in the repo market, and then all of those troubled banks. So if a central bank, it's the central bank is going to lend to its member banks. This is kind of the way that they work. The central bank is going to lend to its member banks. The member banks are going to lend to those troubled shadow banking firms that are having all of this trouble getting loans overnight so that they can pay their obligations. So it's a two-step thing. That's usually how it goes. It's very similar to what the Fed did in 08, very similar to what the Fed did in 2020. If the problem is the corporations can't get loans, the corporations can't sell their bonds, well, then the Fed is going to offer the banks loans to which they can post those bonds as collateral, and then the banks will lend money to whoever. So it's usually a two-step process.
Okay.
It's all
All right.
yeah, it's
Okay.
all
So
getting
now,
around the legal restrictions and whatnot.
all right. So they're engaging in the maximum amount of, I don't know if you're calling it stimulus or bailout or
Yeah,
what.
yeah. So they're in stimulus mode, and then a few days ago, I don't know if it was Bloomberg or the Wall Street Journal. I'll find the link and I'll send it to you. But it hit the news that they are contemplating their own version of QE. Right. So China doesn't do QE, but they do QE. What China does is they do what the U.S. government, what the U.S. Fed did in World War One. In World War One, the Federal Reserve did not directly go out and buy U.S. government bonds. What they did was they extended credit to its member banks at a fixed rate of interest, a really low one, like 1.52%. And they said, if you buy the US government bonds and then post them to us as collateral, then we'll make sure you have the credit to go and do that. And so by extension, they were making sure that there was always a market for US government bonds, and that market would only charge a really low rate of interest. That's what China is about to do with their real estate sector. It's targeted quantitative easing that basically takes a two-step process or a backdoor, whatever you're going to call it. They're saying we are going to make money available to our member banks at an interest rate of, call it 1%, 1.5%. The banks are then going to go lend it out to all of their shadow bank friends, the Evergrandes and the Country Garden, and some of these trust companies who are no doubt getting loans from the actual banks in China. And then they're going to post those loans as collateral to the People's Bank, and the People's Bank is going to keep that credit afloat. That's basically China's version of QE. And like I said, a few days ago, or maybe probably sometime last week, we heard that was probably going to be in play, and I don't know when they're actually going to start. But the journal's report was that they're contemplating it. And then the other thing, again, money rates are, like I said, they're the canary in the coal mine. So money rates for some borrowers in China on October 30th, 31st, something like that, they hit 50% for some of these non-bank
Whoa.
financial. Yeah. So
I mean, that's
for
restructuring.
yeah,
I mean,
exactly.
they should just buy their own bonds in the open market at that point.
Right. Yeah. So you have some of these borrowers who are, so they're paying 50% for 7-day money, basically. The reference rate or the benchmark for that would be the People's Bank of China's rate, which is 1.8. And then even at the same time, that was only applied to some borrowers, right? So not everybody's having to pay for 50%, but some are. It's very similar, actually, to what happened in September 2019. That's basically what's happening to China right now. Is September 2019, coupled
Yes, that
with a
crazy repo
huge,
thing. Yeah.
yeah, a huge downfall in the real estate sector. So uh, real estate their own real estate deflation plus September 2019 is basically what's happening in China right now. And the central bank is responding. They've gone from any possible indication of tightening mode, which they were never really in because they haven't raised any rates, but they have gone from any pretend tightening mode to full stimulus mode. Let's get this going again, baby, somehow, you know. Um, and it's just the fact that this could be isolated to China, but the fact that the German bond yields, the British bond yields, the US bond yields, and all of the interest rate futures are all doing the same, and oil prices at the same time, just tells me that there is something systemic here that we are not necessarily going to understand until it all kind of, until we're in September 2008 mode, or until maybe a year after that when somebody really digs in and can illuminate all the different connections. But the truth is in the price, and all of the prices are around the world are saying this is not limited to China.
So what do you have an expectation for how bad it could get in China? Is there enough like actual information out there? Are you looking at that?
Well, I think that the risk for China is that they have not allowed a full deleveraging. So, like I said, they've been piling onto this debt bubble for 30 years. A lot of that debt is denominated in dollars, and that's really the stuff that they have trouble paying. So their risk is honestly, like, they're having deflation right now, but they do run the risk of having a really bad inflationary spiral where the central bank can't juice that credit sector anymore, and just based on the fall in the value of their currency. Now they can continue to prop up their currency for a really long time because they have about $3 trillion in foreign exchange reserves. So if the value of the Chinese renminbi falls too much, the People's Bank or the Monetary Authority, whatever, they can sell some dollars and they can sell some euros and some yen, and then they can prop up the value of the renminbi. They can do that for a really long time just because they have a ton of FX reserves relatively. Um,
Mm-hmm.
but I think if they continue to have to just prop up their currency that way, and they try to stimulate more credit, what's going to happen is that credit is just going to get used to pay off the old debt. It's not going to generate any more activity, and so they could actually start to see a lot more unemployment. And just a really crappy economic stagnation, kind of what happened to Japan after
Yeah, I mean, it
1991.
seems to me something that artificial, that systemic, that big, that
Mhm.
doesn't have a lot of natural ways to work it out
Yeah,
could be
they
a
basically blocked
decades
the exit.
long thing.
Hmm.
Yeah.
Yeah, yeah, they basically blocked the exit, and it's kind of similar to what happened to Britain between the World War I and the Great Depression. There was not a great time to be in Britain either because they were artificially keeping the exchange rate against gold higher than it should have been, and they were manipulating that with monetary policy, and then you had the Fed manipulating that with their monetary policy, and so the economy just stagnated. In the U.S., we're having the Roaring Twenties, and in Britain, I mean, they really paid for like 25 years for their World War One. Like they had
Yeah.
basically 2 decades of depression and then another World War. So yeah, it's looking like that's what I would say. That's what I would guess is just a good lost decade in there for China.
So to wrap that up, and where I'm interested in right at the second is, and this will be our last, exchange of the night. Next year, like under normal circumstances, like the previous American paradigm, you would expect the Fed to lower rates a little bit, cut rates in an election year to help like the fearless leader at the moment,
Hmm.
and that the incumbent would be the candidate and all of that. So I mean, it looks like they are on track, and the fact that rates lead So you see it happening whether they do it or not. Uh, do you expect that? Like, what do you what's your outlook for next year in a nutshell?
Yeah. So I think that I wrote an article, and I'll send you the link to this. I think that the Fed is already planning on rate cuts, and I think that they signaled this through the Wall Street Journal on November. I want to say it was 14th. So the CPI reading for October came out, and they engineered an article in the Wall Street Journal because the Fed has for 20 or 30 years now they've had Fed whisperers. So the current guy is Nick Timmerhouse. Oh yeah, it's in the white paper too. But so they put out an article that totally looked like Fed speak, but the title was "Cooling Inflation Likely Means an End to Fed Rate Hikes." And in Jay Powell's last press conference speech or whatever, he did not rule out further rate hikes, but you kind of have to, weed out what they say from what they do. And I actually believe that the Fed is looking at what's going on in there, over there, and they are fully anticipating this to have ramifications in Europe and in the US, and that they're already planning to set the table for rate cuts. And I
So
think
that
that that's
would
why they put that article in the journal on November 14th.
so the ramifications of China for the West would be lower rates because money would exit, right?
Yeah, lower rates because ultimately that's a drop in demand for the US and Europe. And so, that's your recession right there. You're going to have less demand for inputs from China. I mean, I know we're a
Oh, I
net
was just
importer.
thinking to the extent people get to invest in China, I really don't know how it works because they have that weird,
Oh
it's
yeah,
been such a close.
there's not
So
a ton of
it's
US
not like you
investment in
have
China.
for
You'll have a little
us.
bit.
Yeah. So for us, like the dollar gets strong, interest rates go down, like, that
Right.
kind of thing. That's not the impact you're looking at. You're looking at actual like economic, the goods flow and yada yada.
Yeah, I'm looking at that, and there will be a flow, and there already is. Like there's been, I think, $25 billion leave China in the last year. That was in the Wall Street Journal a couple days ago. But the amount of relatively, it's like less than 1% of Americans' asset portfolio is invested in China. So it's very limited the amount that can come back. So there will be an effect and I think there already is. I think that's part of the reason we see these huge declines in the risk-free rates in those 2-year bond rates, right? Is because money is moving from one place to another, whether that's money moving from China to the U.S. or money moving from somewhere tangential to China, like maybe Korea, for instance, to the U.S. Who knows? But those price movements mean something, right? It means the money is piling in to the U.S. bonds. I mean, yeah, and I think that the Fed right now sees systemic risk with what's going on in their money market. I think they are concerned that it can spill over to the U.S. and Europe, and I think that November 14th thing was literally setting the table for rate cuts, and I think they're here. They're going to be cutting rates in the first or second quarter of next year. Like I'd say that's base case.
Okay, very good. And who do you think is going to be president in February 2025?
I'm gonna be real wild, and I'm gonna say Gavin Newsom.
Whoa, please,
Yeah.
God help us all.
I don't
God
want it.
help us
I don't want it,
all.
but yeah. I mean, I don't know. Maybe Biden like holds on until
Fair enough.
then, but I don't know. I
I
think
I
I'm
met my
still holding
best
out.
friend out here because it's the craziest story, which you've probably heard because you listen to my show. She was
Mhm.
walking past my house in an impeach Gavin Newsom shirt on. I don't know this chick. I just moved into this neighborhood and I talked about it on the show. She heard the show. We posted it so fast that she heard the show while she was still wearing the shirt.
Oh
And
wow.
she tweeted at me for join Twitter just to tweet at me. I didn't even see her tweet for like a month. And
Hmm.
now I go on that walk with her all the time, but
Oh
we
cool.
bonded over impeach Gavin Newsom. That's
Well,
how that's how much I do not hope for Gavin. But you know what? It doesn't matter. Nothing, that stuff doesn't matter.
I
What
mean,
you're
why did they
talking
put
about
him?
matters a lot more than who's on the throne.
Oh yeah, yeah, and because it doesn't. Republicans and Democrats get. It doesn't matter what happens, who gets elected president. You get John McCain. That's what Tom
Ah,
Woods
yes,
says. Like it's
totally,
it's
for
always John
sure,
McCain.
for
Doesn't matter
sure.
who you vote for. You get John McCain.
It's so funny.
So, but yeah, I mean, why did they
Ah.
put him on the debate stage with Ron DeSantis? I don't know.
Oh, I know, that's so
You
crazy,
know,
that's so crazy.
yeah,
So, like, is Michelle Obama gonna debate Kamala Harris? Like, how what weirdness is gonna fl of course, you're right,
yeah,
of course. It's not yeah, nothing happens for no reason.
yep.
Okay, super interesting. So, I was thinking that we would wait on the little historical, that the we have to plug that gap on the Bretton Woods thing on it at another time. But look, see,
Glad
this
we did
happens
this
every
though.
time we chit chat and it goes on for like a couple of hours.
Yep.
But people have stuck with us. That's super cool. Um okay, we
American
gotta go.
Psycho's
My
president. That's
dog has
great.
been badgering me to take him out.
Yes,
And it's been absolutely great to see you, Jason. Thank
you
you. I
too.
know that you're super busy and for you to take that time. Thank y'all for
It's a
coming.
delight as always.
And just can you say again where, people can find you? Jay Purcell?
Yeah, just jpurcell.me, and if you want to send me an email, contact at jpurcell.me, and I'm working on getting back on Twitter. So
Yes,
I'll
I've missed
when we
you
do our
there.
next episode, I'll
I've missed you. Okay, thank you so much, Jason. See you next time. Thank you all for coming. This has been a live dive on Deep Dives with Monica Perez.